The Hong Kong Institute of Chartered Secretaries recently held its 10th biennial Corporate Governance Conference. In the first of two presentations in the following session, Mr. David Graham, Chief Regulatory Officer and Head of Listing Hong Kong Exchanges and Clearing Limited, traces the rise of environmental, social, and governance reporting, and analyzes its contributions to the exchange, to listed companies, to investors, and to Hong Kong as a whole.
This session is entitled External Stakeholders and Corporate Governance, at the Table or Just Noisy Neighbours. And for the next 20 minutes, I'm going to focus on environmental, social and governance, so ESG reporting, and what it brings to the table for the exchange as a regulator, for listed companies, for investors, and for Hong Kong as an international financial centre. And I'll try, I think, as part of this to say why I think we should care about this topic. It's been probably one of the subjects in the corporate governance area that has been one of the noisiest topics in the last 12 to 18 months. I think it's a very important topic to have on the agenda. One of my colleagues who helped prepare my remarks for this conference drew the analogy of ESG and a symphony, which requires a conductor and an orchestra to work in harmony. And she put together the idea that the exchange is like the conductor, and the listed companies and the investors are like the orchestra. And it's important that we all work together if we're going to make beautiful music. So let me run through why I think we should work to try and achieve that. So let me just start by talking about the key aspects of the exchange's regulatory role, which is obviously my function as a day job. This includes facilitating communication between listed companies and investors. It's about promoting good corporate governance and reviewing and developing the exchange's regulatory framework on an ongoing basis to make sure that it remains up to date and in accordance with international practice. And ESG reporting is an important element of all of those aspects. The exchange has a statutory duty to ensure an orderly, informed and fair market. It therefore plays an essential role in facilitating communication between listed companies and their investors, with a view to ensuring that investors are given sufficient information to make properly informed investment decisions. Increasingly, it's recognized across various sectors of the market that being informed doesn't just mean having access to financial information. It's equally important to have access to non-financial information. And while financial statements are important, investors and other stakeholders are becoming increasingly aware that they are not sufficient in themselves. It does not tell the whole story of a listed company's risks. It doesn't tell the full story of their access to capital, their cost of capital, their ESG-related risks and opportunity, and their ability to manage and capitalize on those risks, or indeed the opportunities that they give rise to. While the traditional approach of investment analysis and decision-making may have been based traditionally on a listed company's track record, investors are increasingly looking at a listed company's ability to sustain their performance in the future. And ESG reporting can provide investors with insight into the long-term sustainability of the company's business. However, despite investors' growing interest in ESG information, it's very clear that listed companies are yet to meet investors' expectations in this regard. A 2015 survey of institutional investors around the world, conducted by Ernst & Young, found that investors are simply not getting the ESG information that they want. Nearly 2/3 of these investors said listed companies do not adequately disclose ESG risks. There's therefore a gap between the information that investors require and what companies are currently disclosing. And the exchange has a role in closing that gap. Secondly, the exchange also plays an important role in promoting good corporate governance amongst its listed companies. This is because good corporate governance is a key ingredient, again, in the sustainability and long-term performance of companies' businesses. We believe that ESG reporting can help companies improve their corporate governance, particularly when it comes to their ability to manage and control risks. We also have a statutory duty at the exchange to continually review and develop our regulatory framework, to make sure that it's up to date and that it's aligned with best international practice. In recent years, a notable global regulatory trend is that governments and regulators in many overseas jurisdictions are increasingly taking steps to encourage or even mandate, in certain circumstances, ESG reporting. According to a research report published in May of this year by the UN Environmental Programme, GRI, KPMG, and the Centre for Corporate Governance in Africa, the number of laws and regulations in this area has more than doubled since 2013. If there was a prize for the fastest growing regulatory trend, ESG reporting would win by a large margin. Against this background, the exchange provides a framework to facilitate ESG reporting by listed companies. This framework, set out in the ESG reporting guide under the exchange's listing rules, was initially introduced as a recommended, i.e. voluntary, practice in 2012. As most of you will know in this room, in 2015, we introduced a revised ESG guide and related listing rule amendments intended to strengthen the disclosure requirements in relation to ESG. This followed a detailed consultation on proposals to upgrade the disclosure obligation of the guide, and this met with strong support from a broad range of respondents. As a result, listed companies are now required to publish ESG reports on an annual basis and to report on certain areas of the guide. Much has been said about the benefits of ESG reporting, and I don't intend to go into too much detail here, but let me just highlight what I consider to be some or a few of the very important points. First, numerous studies show that ESG reporting can help companies improve their corporate governance, and in particular strengthen their risk management by prompting them to assess ESG-related risks to their business and preparing them to manage those risks better. It can also attract investors and incorporate ESG criteria into their decision-making, enhance company share valuations, and enable them to secure financing from lenders more easily. It can be instrumental to a company's reputation, especially in an era where social media can make or break companies' businesses. It's not only important from the angle of attracting customers, but also to recruit and retain high-caliber employees. Studies show that a company's ESG reputation has increasingly become an important factor in an employee's choice of employer. There's also strong evidence that shows that ESG reporting can help companies save costs and run their operations more efficiently. It prompts them to review, identify, and address any inefficiencies in their consumption of resources such as water or energy. On the flip side, it also enables them to capitalize on new business opportunities, which in turn can drive innovation, for example, through the development of greener, more resource-efficient products. Given these benefits, it's no surprise that evidence shows that ESG reporting is linked to stronger financial performance. For example, a 2015 study found an overall positive link between embedding ESG criteria into the investment process and improved corporate financial performance. The positive correlation may be due, of course, to numerous factors, but the underlying thread is that ESG reporting reflects management strength and therefore the long-term prospects of the company. So I've spoken about what ESG brings to the table for the exchange and hopefully some positive points about what it brings to the table for listed companies. But now let's talk about what it brings to investors. As I mentioned earlier, investors increasingly recognize that financial statements alone are not enough for a comprehensive assessment of a company. Investors, as well as other stakeholders, benefit from greater transparency around a company's ESG practices because they provide an important window into the quality of a company's management and its ability to manage and capitalize on ESG-related risks and opportunities. Their growing interest in ESG information is again reflected in the results of a 2015 survey, which showed significant increases in the number of investors embedding ESG disclosure into their investment decisions. For example, the percentage of investors who considered ESG reports essential or important when making investment decisions rose by 24% from the previous year. ESG information is also important for the responsible investment market. Investors in this space incorporate ESG criteria into their investment strategies, not only to generate long-term financial returns, but also positive society impact. The responsible investment market around the world grew an impressive 61% from 2012 to 2014, according to the Global Sustainable Investment Association. The growth of responsible investment is also reflected in the development of investor-driven initiatives in this area. These include the UN-supported Principles for Responsible Investment, the CDP, and Carbon Action. These three initiatives alone are backed by investors with more than $100 trillion in assets. And finally, let's consider what ESG brings to the table from a broader perspective. We've talked about it from the perspective of the exchange, listed companies and investors. But what about Hong Kong as a whole? Hong Kong's position as a major international financial center is widely recognized around the world as a highly competitive economy and business environment. As has been mentioned earlier, amongst our other achievements is we've ranked first globally in funds raised from IPOs in 4 of the last 7 years, and has been in the world's top 5 in IPO fundraising every year since 2002. To maintain that sort of level and to be at the forefront of our competitiveness cycle, we must stay ahead of regulatory trends, and one of those trends is ESG reporting. We simply cannot ignore it. Developing a culture of ESG disclosure will benefit the market by potentially enhancing listed companies' overall competitiveness, attracting capital from the growing pool of investors that utilize ESG criteria, and bringing in listings by other like-minded companies. So just some final thoughts. In its role as a regulator, the exchange has sought to encourage ESG reporting through the introduction of listing rules and the guide. However, we recognize, as do many of the other speakers today, that a rules-based approach will not in itself deliver high-quality ESG reporting amongst listed companies. Equally important is the development of a corporate culture that recognizes the value of ESG reporting, and it seems we're still quite a long way from achieving that culture. Listed companies' buy-in is ultimately going to be essential to this process. Listed companies need to see the benefit of ESG practices and reporting. With this in mind, myself and others at the Exchange speak regularly to listed companies about the benefits of ESG reporting. And we've conducted extensive training and provided various training materials and resources on our website to help guide companies through the reporting process. Earlier this year, we launched a new ESG webpage setting out practical steps, tools, and reporting guidance to help listed companies report under the revised ESG guide. We provided a series of 12 issuer training seminars, which featured speakers from the listing department, as well as ESG specialists and listed company representatives who provided more in-depth and practical training on ESG reporting. For those of you who are unable to attend and are interested in learning more, webcasts are available on our ESG webpage. Over time, my hope is these efforts will lead to the development of a corporate culture in which ESG practices and reporting are fully integrated into daily business operations, leading to greater transparency, more resilient risk management processes, and value creation. ESG is not temporary noise pollution. It's here to stay, and it has the potential to help the Hong Kong market develop and flourish. I hope that we can all harmonize our efforts in this area to achieve this potential, much as a conductor and orchestra would do in order to produce a beautiful piece of music. Thank you.
In the second presentation, Mr. Cas Sydorowitz, Chief Executive Officer, Georgeson Inc., considers three types of corporate stakeholders who are increasingly making noise: shareholders, proxy advisors, and shareholder activists.
I will focus the discussion on three stakeholders: shareholders, who we heard a lot discussed already, proxy advisors, and shareholder activists. Most of our time is focused on engaging with the largest global investors to understand their governance policies, their voting histories, and interpreting their responses for our clients so they can better understand what they're likely to do before the meeting results show up the day of or the day before the annual meeting. The specific topic, neighborly to make the right noises. This slide would indicate that many investors don't necessarily agree with management. We did an analysis of the largest investors who disclosed their voting history, and we kind of organized the data to demonstrate those investors who vote most regularly in aggregate form across all agenda items. I suspect many of the investors that you see on this list you'll also recognize from your own shareholder list. It should be mentioned that there are some names on here that you may not recognize as state pension funds. Many of them decide to vote themselves while they give their money to external managers to invest on their behalf. So you may know some of the large institutions such as Capital Group, Fidelity, and others who are managing assets for some of the specific pension funds listed here: Florida State Board of Administration, Ohio Public Employees Retirement System. Likely not going to see those investors on your roadshow as you go to the United States. But many of the other names on here should be very familiar with you as you consider your own shareholders. The analysis broke down further into what are the key issues that investors are voting against most regularly on. And it's not surprisingly that director elections, and I'll come down to the makeup on why some of the investors are voting against such frequency with director elections, but the general mandate as it relates to capital increases, the dilution issues related to that. David talked about the efforts on the ESG comms, and we haven't seen as many resolutions covering this topic, although it is worthy to note that in the UK last year, there were two very large votes put to BP and Shell to have the company disclose greater information about their carbon disclosures. The company took those resolutions on board. They were submitted by a shareholder, and the board got behind them and actually recommended that shareholders support them. In the United States, there was an opposite impact on Exxon, who's meeting this year, where shareholders requested something very similar. It didn't require the company to divest certain assets, but it asked for them to disclose more about their carbon footprint. And the company took the opposite view of BP and Shell and was very critical of this and got behind a campaign to get shareholders to oppose that resolution. And not surprisingly, it ultimately failed, but there is a divergence in certainly the US and the UK on how companies react to various ESG issues. Some of the investors disclose themselves why they are voting against director elections. I extracted just a handful of comments. There's many, many more on this issue. But the ones that appear most regularly are focused on independence, lack of disclosure. Many companies will often only provide the name and some minimal information about the directors who are up for election. Institutional investors, certainly Western ones, are looking for far greater detail from the company on those individuals. Overboarding, having too many other commitments, which goes to the very question about how can directors monitor and get involved and have oversight over their shareholders if they can't invest the appropriate amount of time on the board, considering the various board papers and the level of commitment needed. These are comments that your investors disclose publicly. I'd encourage all of you, if you receive letters from shareholders articulating why they are supporting or opposing any issues, that you make sure to respond to those investors. We've heard many shareholders complain that they've gone to the effort of writing to the company, but they very rarely hear a response. If they're disclosing it to the market and they're doing so on a regular basis, that could pose a potential threat for future AGMs in terms of investor support. If we look at some of the top investors who are voting against directors most regularly, Fidelity Management Research, again, will be a name that many of you have seen on your shareholder lists. And we've looked at this over the past few years. While there's some shifting in those top 10 investors, they're largely the same. Imagine as you're engaging with your shareholder base throughout the year, asking them specifically why they are opposing director elections at your company is something that I would suggest is worthy to incorporate into your ongoing communications, certainly for all of the investor relations activity that's involved. Does the market understand your company, and are they valuing it appropriately? Most investor relations is part of their exercise is to sell the equity story to the capital markets, and it's quite difficult if there is a disconnect between how the investors view your company and the company's own performance. The types of investors you attract to your equity story determines not only who you see on roadshows and who participates in conference calls, but also impacts the investors voting at your annual meetings. And if your active managers are more critical of specific governance issues, you may find that the level of opposition goes up at future meetings. Very importantly, as you consider the institutional investors, it's critical to understand where the decision is being made. Who holds the dice? Is it a fund manager in the United States, in London, in Switzerland? Who are their clients? How are they investing on behalf of those clients? Is it an index money? There was other segments of the pie chart that were fixed income, but the active equity management is a smaller component of that. Understanding whether or not your investors own your shares in active portfolios or in passive can have a significant impact. You don't want to engage only when you need something. It's very important that the discussion is an ongoing one. Having a number of situations where the first time the client has spoken to the governance teams at their largest investors, the response has been, "We haven't seen you in over a decade. Why is it that you're now coming to me?" And clearly, that's the worst situation to find yourselves in. It's worthy to just note for a moment that many of the institutional investors divide the responsibility of active ownership, people who make buy and sell decisions, with those who make corporate governance and proxy voting decisions. And while they may be integrated and even sit on the same floors as the active management teams, there is a specific group of people that the decisions about how to vote at your annual meetings is often taken by a different community within the same investors. And while there may be 5 or 10 different fund managers who are deciding to hold your stock in their portfolios, the voting decision process is often concentrated down to a much smaller group of people. Sometimes, in some investors, it's down to a single or perhaps two individuals. Many investors, because of the limited resources they have, rely on proxy advisors to help them with the decision-making process about how to vote. The two largest proxy advisors, ISS and Glass Lewis, should be names that are known to everyone in this room. I have a few stats on here for each of them. Both of them are owned by private equity. Glass Lewis is owned by not only Ontario Teachers, but AIMCO, so they're both a manager of money, an investor, provider of capital, but the holding of Glass Lewis sits in their private equity portfolio. ISS has changed hands many times. It was previously owned by Thomson Reuters. It went to MSCI. And most recently, it was acquired by Vestar Capital. I only mention that because the life cycle of many private equity companies is between 3 and 5 years. So it's been in that portfolio for 3 years, and we may see some change at ISS. Proxy advisors play 3 critical roles. They monitor the portfolios of all the companies that an institutional investor has. It harmonizes the language. It translates the information. In some markets, the proxy material is not released in English. It's only available in the local language. So for an investor to make a considered decision, they need the information in a language that they can assimilate and decide upon. It provides the details of the meeting, the voting requirements and deadlines that are necessary for an investor to vote. Secondly, and probably what many of you know them most for, proxy advisors provide recommendations. They will go through on a resolution by resolution and give guidance to their clients on whether they should support or oppose the specific resolutions based on governance guidelines on a market-specific basis. Sometimes it's by a specific market. In other cases, it's overarching territorial governance policies. And then the third thing that these proxy advisors do is they provide a voting platform. Any investor can vote for all client accounts individually or collectively via the same platform, harmonizing what could be a very arduous and paper or process-intensive procedures for them. It's worthy to note that there is a movement in the United States going on presently to determine whether or not proxy advisors should be regulated and have greater restraints on what they do as a commercial enterprise. I will tell you that from my opinion, that if proxy advisors were not able to offer the services that they do, the overall voting levels of institutional investors would go down considerably. We talk about ESG reporting and whether or not investors are willing to pay for that. Well, institutions ask their clients whether or not they're willing to pay for proxy voting and corporate governance research. And if they weren't able to have the same access to information and recommendations, the levels of overall votes would diminish, I would suspect, considerably. If a large investor is voting thousands of stocks every year, that number will shrink dramatically. As we talk about institutional investors and we consider long investors, institutions who you'd all welcome on your shareholder list, I suspect, I'm going to read a quote from Mark Mobius at Templeton. It's worth listening to. Shareholder activism is not a privilege, it is a right and a responsibility. When we invest in a company, we own part of that company, and we are partly responsible for how that company progresses. If we believe there is something going wrong with the company, then we, as shareholders, must become active and vocal. That's a fairly aggressive position. Not all investors take such a strong position. But I suspect all of you would welcome Templeton, also known as Franklin Templeton, on your list of shareholders. And you would likely see them throughout the year in various markets, perhaps even see Mark Mobius. They're not the only investor who takes such a strong view on the stocks in their portfolio and how they engage with companies. But it's just worthy of note that long investors, institutional money, is becoming more engaged in the companies that they invest in. They have to. Templeton isn't necessarily an index manager or a passive fund manager, but they feel that they have a fiduciary responsibility. BlackRock themselves have been activists in this market specifically. They ran a proxy fight at a company in Hong Kong at the beginning of the year. I also include another example here of Schroders, a large UK money manager who launched a proxy fight at a UK company. It's fairly unheard of. They requisitioned a meeting. Now, you may expect an activist such as TCI, Pershing Square, Elliott Advisors to requisition a meeting. I doubt any of you here would expect to receive such a letter from either BlackRock or Schroders from your shareholders. The growth in activism has been fueled by a number of factors. Outsized returns on some large campaigns in the United States, interest rates being at historical lows globally, wealth managers, family offices looking to deploy capital in alternative asset classes. Not all activists or hedge funds have been overly successful in the last 6 to 9 months, but the asset class has grown considerably. And part of the reason for this is holding companies to account to generate higher returns. Despite some of the levity of the cartoons you see on this slide, activism isn't a joke. It's a distraction for management and requires a huge time commitment. I just mentioned M&A activism is one of the most prominent forms of activism that we're seeing currently. And that has to do with one company making an acquisition of another company and the activists coming in and buying shares of the target, trying to extract a higher value. Activists are using corporate governance issues to attract support from long-term investors. If you think about how activists charge their own clients in terms of fees, their fees are often described as 2 and 20. 2% of assets under management, 20% on a specific P&L return. So they make money by getting more investor mandates, and they are trying to generate oversized returns. Just overall, globally, the level of activism has been on the rise. And more importantly, the success of activists and how you define success from an activist perspective has also increased. Don't forget, an activist may not be trying to achieve a specific outcome at a specific company, but they may be looking to attract capital from more investors. And so a very high publicity, highly publicized campaign could be targeting a different objective, different from what other shareholders may ultimately want, and it's worth noting that. Activists spend an enormous amount of time doing due diligence long before their holding is ever disclosed. They describe themselves as private equity style research, committing 1 to 3 man-years of research time focused on the company, and they look at all of these different stakeholders that are relevant. They employ experts to support them to ensure that level of success, and these are only scratching the surface of the types of advisors that they will utilize to attain their objectives. I won't read all of these, but I'll leave you with focused on one. Activists are shareholders, and many activists have a very concentrated portfolio. So unlike an index manager that may have 10 or 15 or 20,000 stocks in their portfolio, most activists have between 5 and 15 stocks. That means they know the company incredibly well and may know it even better than some of the non-executive directors who are on your board. They are committed and they want to see change. They aren't necessarily going away after a short period of time. How can you be better prepared? We've heard it throughout the day. Re-emphasize this point. It's around shareholder engagement, making sure your strategy is well documented and well communicated to your investors, that there is alignment between your shareholders and your own strategy, and that is understood. You can wear interim problems, financial results, if it's well communicated and you understand your shareholders. Just kind of summary, just worth noting a few things. We heard about the report about shareholder engagement. This is being echoed in the UK. There is a report that's been submitted to Theresa May, Restoring Responsible Ownership. Again, it echoes many of the same principles that are in the report here. This is not unique to Hong Kong, that investors are looking to hold managers to account, and here too they were putting responsibility on the investor community. And I just finish on this one, because this is quite an interesting development, and while there's no indication that it will arrive here or elsewhere, many institutional investors in the UK have come together and created the Investor Forum. It came out of the K Review a number of years ago, and it's an informal organization, although its membership pays very significant fees to be part of this. And the Investor Forum takes the views of the institutional investors and articulates or translates them to the board of the companies in which they're targeting. It's effectively a mechanism for institutional investors to become more active without having to wear the responsibility and bear the timely cost of doing it themselves. In many respects, I think the Investor Forum is a mechanism of activism for some of the long institutional investors. It's worthy of note just to be aware that your largest shareholders regularly engage with each other throughout the year on a number of engagement practices, whether that's in the US, the UK, or even here. With that, I'll conclude. I hope I gave you food for thought and for our panel.